Paul?
I actually have a quick go back
What?
to the capture ratio. Carried interest is actually included. So what is not included is the underlying portfolio company fees. So just wanted to clarify that.
Okay, thank you. Paul?
First of all, glad to hear that, because as I calculated the capture ratio of that didn't include carried interest. When you included it, it would have only been 30%, which is not very good. So I'm glad that it's like 72%. That's thank you.
I'm glad we made that clarification. And if you go to IMV 101, it'll talk about the capture ratio analysis and what it includes and what it excludes.
Okay. So,
Take the village, right?
so thank you. It's very complicated. And first of all, congratulations. This is great. This report gets better every year. It tells us more. It helps us see what we're doing and make decisions. And it's really wonderful to see. I know it's a lot of work, and it's a great commitment on the part of the staff, not only to produce this report, but to bring fees down, and they work together. So thank you very much. I guess, well, I was going to ask about the capture ratio, but now I don't really have as much to say. I mean, it is interesting. The numbers are very interesting. I don't think we should draw any conclusions from it. It is interesting that the the capture ratio for private equity is a lot lower than for real estate. There could be a whole lot of factors there that I think in the future it would be good to have an understanding about that. I'm not ready to ask you or for me to presume why that might be, but I think that's the next step, is for us to understand that. I did have a couple of questions about this page though. What do we mean by, what does it mean by industry standard costs? That first column.
Sure, I think that goes back to our struggling with what we should define as what kind of costs to include. So right now, the way the industry defines net and gross, net versus gross, the net is really the net of carried interest and management fees. So
in other words, our costs, if measured by industry standards, not our larger definition. Okay.
Correct.
And then over towards the right, 3-year net returns, TWR. What does TWR stand for?
Sorry, time-weighted return.
Time-weighted returns.
Oh, Karen.
There you go.
Miss Yamamoto.
Thank you.
Miss
Good. I
Yamamoto.
should have known that. Good. Okay. Okay.
Miss Yamamoto.
And finally, and this doesn't have to do with the capture ratio, but there was the recommendation by the
audit?
Yeah, to hire a firm to independently verify costs on the
Correct. And to just to
private
give
equity.
some context to Mr. Rosenstill's question, at the Audit Risk Management Committee, there was a recommendation for our private equity team to hire an independent consultant to verify and recalculate management fees for private equity. And so what we've done is we've awarded that contract, but we haven't actually executed it yet. And so I think our last update was we were negotiating terms and conditions, but we hope to execute that contract and have it in place in the next few months.
And so what would that firm do that's different than what Pavilion Mercer is doing?
Go ahead. So Shavat actually was on the panel when Margot and her team hired this contractor, which is, I believe, is Colmar Incorporated.
So I think the difference is Pavilion helps us collect costs for all the private assets in detail using the ILPA template. What Colmar would do is it's on a sample base. They will recalculate the fees to make sure that they're accurate. So slightly different.
Is that just a check on Pavilion, or is that a separate endeavor to measure the fees.
It is separate and independent, so it's completely separate from Pavilion's initiatives.
And I wanted to add, like, Pavilion does a reasonableness check, but they're not going through and independently recalculating the entire thing. They do a reasonableness check based off of the commitment size, off of the financial statements, off of what was reported. So reasonableness versus completely recalculating.
Got it. Okay, thank you.
I think you have it. So one is to collect and analyze the data. One is to verify the data. So what did we pay in fees and how much versus was the fee in accordance with the partnership agreement?
Great, thank you.
Is it, Paul?
Yeah.
Okay, it's been said, thank you for the report. You know, four years ago or so, we didn't have this report. We now have it now, so we have 3 years of data. Even longer, over a longer time period, in the public markets, we've brought some assets in-house, considerable number of a considerable figure without giving up returns. And as a result, we're managing that capital in-house at a lower cost. We have data that shows on a relative basis it's managed compared to our peers. This is managed cost effectively. We now have a new concept, captured ratio, so that we're keeping more of our profits, and that's a work in progress. So we look forward to the next stage and step in the process. We have the collaborative model that we'll be discussing. Potentially that will also, I can't help but think of John Bogle, right? So we want to keep more of our capital, right? At the same time, I do think we need to be sober about what the capacity is for a public institution like CalSTRS in private equity. We won't be able to do and generate the types of returns that some of our GPs do. What we want to do is, and it goes back to the alignment of interest, we want to drive that alignment of interest, and we want to keep more of the profits for our beneficiaries without giving up returns. And we want to measure that over time. Before we close, just I think for the record, can you just estimate the amount of human hours that goes into this report?
So as I mentioned earlier, it's a team effort, not just the panel that is represented here, but it's probably about 1,500 hours.
It's time well spent. As you look at, we're running at about $140 million less than what a comparable fund would have paid for the same type of results. So thank you to Paul and Sharon for driving this a few years ago. We now have, I think, something of substance that we can build upon and continue to refine in the years ahead. So thank you for your hard work and your efforts. We look forward to next year's report, which will be 2018. Okay, thank you.
Thank you.
Our next item is Scott Chen. Scott? $1,500, that's a lot of time. Benchmark education, and as the item says, this is the first education, so it's going to be a high-level general education on benchmarking, and there will be subsequent presentations that would be more granular and into more of the details. I'll turn it over to you, Scott.
Well, good afternoon, members of the board, and thank you. I'm really excited to present today Benchmark 101A. And I wanted to give credit to the collaborative effort here that went on. The consultants contributed a lot to this presentation. So if you don't like the presentation, blame me. If you like it, then you can give them credit. As Harry was saying, we wanted to just lay out a basic foundation, knowing that there could be new board members coming today, to provide more advanced benchmark education. Of course, there are several members of the board who had asked for this education throughout the last year. So today we want to cover the who, what, where, why. Essentially, why is measuring investment performance important for CalSTRS and the board? What is a benchmark? How do we go about selecting benchmarks? What are benchmark methods that we use? What are we trying to measure? And importantly, I want to get into the governance and the framework because the board should be interested in what they're involved in, which is setting the policy benchmark, as we've talked about the strategic asset allocation, and then aligning the staff in implementing that via the investment policies where you set the sub-asset class structure as well as the compensation policies. So let me click forward. So why is measuring investment performance important for us as well as the board? I think the starting point is accountability. You can manage what you can measure, and we want to know if we're achieving our long-term objectives. And in the short term, what are the reasons we're off course or on track, right? And I think that you've heard the old adage, past performance is no indication of future performance. And that's why we have to look at the past to see if we can make better decisions, but the key is attribution. It's why has the performance been the way it is? And we'll discuss that in more detail as we go along. And then finally, governance and alignment. Because as has been mentioned so many times today, the board is setting the strategic asset allocation, which is represented by the policy benchmarks, the roughly 20 of them that I've indicated in the presentation. And everything needs to be aligned to that. All of our staff's implementation and the consultants need to be aligned to that. And what are the tools that create that alignment in the framework and foundation? I want to say that benchmarks are simple to understand, yet you can see throughout the presentation and hopefully in the memo that I produced that selection is complex. And I had debated about making this presentation, the memo, super simple or getting into some of the complexities of the benchmark. I thought that it would be more revealing for the board to understand the true complexity around benchmark selection. So what is a benchmark? We use benchmarks all the time in everyday life. And I thought the best way to explain all of these points is by giving you an example. That example is my commute home. So if I said that it took me 75 minutes to get home, is that good or bad performance? Well, it would help you to know that I average 65 minutes. So in this case, the absolute return was the 75 minutes. And in the case of a manager, let's say the manager generated 10% return, that would be the absolute performance. But the relative performance was 10 minutes over in my commute, so I underperformed, right? The attribution is the reasons why I underperformed. So if I underperform because we think that long-term there's going to be more traffic, then we can project forward that would be persistent, that performance would continue. But if you knew instead that there was a 3-car accident, essentially you would think, well, I'll probably get back to averaging that 65 minutes in the commute. And the same thing can be said about our managers. In the memo, I provided an example of a manager, and we try to break down the risk factors, what risks and active decisions is this manager making, and draw clues to whether the manager can outperform. That example was of a U.S. core manager, and we broke it down by its style risks and made some mention as to why that performance might be continuing or not continuing. I wanted to show the picture of the high jumper. I was going to say hurdler. The high jumper shows you that setting the benchmark, we need to set a reasonable benchmark. So let's say, for example, that benchmark is too low, that's poor alignment with our manager. The manager is earning fees on something that would be easy for him to do, right? But if we set the benchmark too high, the manager might act in a way that is riskier than he normally would just in order to jump higher. And the high jumper would maybe change his technique in order to, hurdle over that benchmark. So before we leave the page, I do just want to make a mention too that it's really, what is a benchmark? It's really about measuring the performance and understanding in the short term and in the long term, are we achieving our objectives? So how do we select? What are the criteria for selecting an effective benchmark? I think the first thing to look at is defining the universe of securities, because as we define the universe of securities, it defines the risk that we're going to take. And I show a picture of a universe with 7 asteroids hurtling through. Is this the type of risk we want to take? Would we rather see 2 asteroids hurtling or optimally 0 asteroids. And the universe that the board sets is really the policy, the policy benchmark. So you set the strategic asset allocation that is represented by the policy benchmarks, and that defines about 97% of the risk that's taken. You heard that in the asset liability study. So that's really setting the universe and the risks that we're tied to in the long term. And the other 3% you can say is part of the execution and the implementation by staff. So what are the other criteria? That's probably the largest criteria to consider is the risks that you're taking and how the benchmark is going to define that. But what are the other criteria? One is being unambiguous. So that just means securities are clearly defined and weighted. It's investable. We can actually own the portfolio. It's measurable. Performance can be clearly measured at distinct intervals. It's appropriate. It's consistent with the manager's style or area of expertise. And it's reflective. It represents the market of the asset class. It's specified in advance, so we can construct it before the evaluation period. And accountable. We hold managers accountable, so they should understand these benchmarks and be held accountable to them. Yeah, go ahead.
Just on those criteria, some of the board members, there's new board members, seasoned board members, they see you all are going to see lots and lots of benchmarks. Some of those benchmarks are widely used. That doesn't mean that they perfectly meet every single one of these criteria. In fact, probably no benchmark perfectly meets any of these criteria. And there's going to be a range of particular benchmarks to be able to meet these criteria, but no benchmark is perfect, and it's important to just recognize that.
Yeah, and I think that's a really important point. In fact, the more challenging it is really in the alternative and illiquid assets. And so it takes a lot of judgment to understand the risk characteristics and appropriately select and match the benchmark. And at the end, as Neil said, it's not necessarily the ideal benchmark that matches all of these criteria. So moving forward, benchmarking methods. This is where we would compare our criteria and try to understand what constitutes a good benchmark. And CalSTRS utilizes all of the above benchmarking methods. These aren't all of them, but I tried to list some of the major benchmarking methods that are out in the market. And we all probably gravitate towards a market index because if we were to think about the criteria, it just about checks all of the boxes. Where it might score as a maybe is really in the appropriateness because some market indexes are too narrow and they cover a very concentrated set of securities, which wouldn't be appropriate. Peer groups is another one that we use, and an example you could think of is in examining a hedge fund manager. How do you create an index? A lot of times you're going to create an index through a set of other managers, a peer group, and compare that manager to it. So unfortunately, that is measurable, and we can use it as a benchmark, but it pretty much fails a lot of the other criteria. And in particular, because a lot of the returns are self-reported, you get into biases like the self-reporting bias, where a manager will report when his returns are good, but not report when they're poor. And you'll have survivorship bias, where a manager will drop out of an index because he's not doing well. So there tends to be an upward bias to a lot of those benchmarks. Risk factors, absolute return is another type of benchmark methodology that I'm sure you're familiar with. You can think of the example of our assumed rate of return, which is 7%. That's an absolute return-like benchmark. We talked about the cost report, and you can think about on a private equity basis, if they have an 8% preferred return, we earn that return before they earn carried interest or incentive. So those are examples of absolute returns. And again, absolute returns are measurable, but they fail a lot of the other criteria, but we can use them for certain circumstances. It does make sense. Risk factors is another one of the major benchmarking methods, and I think this is a newer area where if we looked at the markets, there's been a lot of academic studies as to what risk factors or risk premia generate long-term returns, and then we can form that into a benchmark. These are style factors such as value and momentum, low beta, et cetera. And you can imagine that blended indexes, in fact, most of our policy benchmarks are blended indices. So they blend all four of those different major types of benchmarking methods into one index. And custom indexes, for us, you can think about a customized index in the sense that we have chosen to divest from a number of securities. So, essentially take a small sliver of that index out and create a custom index. We also have custom indexes for reporting because occasionally we have changed the benchmark over time and we have to customize it and keep track of the historical record of that. So what do we measure? We measure across primarily performance, but also risk and liabilities. And we're going to be measuring across all levels, the total fund, our asset classes, sub-asset classes, and the internal and external fund managers. We also need to measure risk as it's related to performance. You saw some of that. You've seen some of that in the reports, but we want to look at the absolute risk of the organization, volatility. That's usually defined as the active risk or the tracking error, information ratio, and on a liability basis, because we're a pension fund, what is our funded status, our assumed rate of return, and the contribution levels and the volatility of those levels. So really, it's important to measure not only across investment performance, but across risk and liabilities of the total fund. I wanted to just show a quick snapshot of the liquid and illiquid market. And you can see that about 86% of the market is in liquid assets. And that's also reflective of our asset allocation. We have a lot more of our assets invested in public markets than illiquid markets. But I wanted to show it because as we're looking through the benchmarking methodologies, it is more, the criteria that are most effective typically follow market indexes, which we have on our liquid and public assets. So a lot of what we do, it's easier to select effective benchmarks. But on the illiquid side, that's where you do see some of the challenges that we've discussed. So this is a chart that I really like because it talks about the benchmark selection across the portfolio. And you can really see the breadth and the depth and the complexity of the benchmarks that we are choosing. The top of the pyramid, where the red dotted line and above, is what the investment committee is making decisions and has decision points on. And I think as I showed this chart to Chris, he was really shocked. He was shocked that there are 55.
I was going to say, I had to turn on my microphone. You get into the trees and you don't step back and look at the forest. But I really was, when Scott put this together and showed it to me, I was like, wait a minute. You mean the investment committee has 55 benchmark decisions based on policies? But that's where we've gotten to, because at the beginning it was very simple. Equity, or U.S. stocks, and then non-U.S., then emerging markets, then ESG. So, and the fact that it's crazy to say that we have well over 500 indexes that we're using. The complexity is mind-boggling.
Yeah, and we could easily draw a reverse pyramid in terms of the risk and return and how that's generated, in the sense that the very top of the pyramid is where all of the risk is going to be encompassed, in the sense that as we choose the 20 policy benchmarks, that defines 97% of the risk and return of the portfolio. So we'd easily draw a reverse diagram in terms of the importance of these decisions. So I'm not going to belabor the point, because we went through a number of the challenges as we went through the different benchmarking methods. There's a few others, and I'm going to cover governance in aligning the different objectives in the following slides. So I think it's important to understand and what's important to the board to understand is what is your role, what is staff's role, what are the consultants' role, and how is this all aligned? So starting with the investment committee, we're embarking on the asset liability study. You're going to set the strategic asset allocation, and that objective is to fund the liabilities. 61% historically of that strategic asset allocation decision is responsible for funding the liabilities. And the other part are the contributions. So that objective then is displayed or represented by the policy benchmarks that I have displayed in an ensuing slide. And you see an asterisk there for the consultant's role, that the board really works closely with our independent consultants to provide that independent advice in getting to the policy benchmarks. And we'll see also their role in the compensation benchmarks. So that is, as we discussed, the single most important decision, and we need to align everything to that decision. There are two primary ways that then the board creates a framework to do that. And that's shown on the column over, the investment policies. So the board is setting the investment policies, which set the framework for implementation by staff. And you're really, on a benchmark level, going to be setting the sub-asset structure and the benchmarks that are created for that sub-asset class structure. So we'll have a asset class such as RMS, and then you'll have the sub-asset class structure within that. TIPS, for example, is one of the sub-asset class structure, and so forth. So then it gets to staff's role. Staff's role is really to implement that strategic asset allocation and the policy benchmarks that the board has put together. But our objective is slightly different. That objective is to do better than the policy benchmark. So we want to do better on a return basis and generate higher return by taking some active risk. But we also want to make decisions that are less risky. So our role is to optimize that portfolio and to implement in a way that hopefully generates better return at the same or less risk than the policy benchmarks. And so our objective includes more understanding of the performance attribution and how to incentivize staff in order to implement. And we'll get involved in choosing the actual manager benchmarks, as well as the sub-asset strategies that are right below what the board has decided. And I think this brings us to the last governance tool for the board in aligning those objectives, staff's implementation to the strategic asset allocation, which everything we do should be aligned to that, and setting the compensation policies. And that objective is different than the staff's objective, which is a little bit different than the investment committee's objective. It's really to incent and motivate the staff. And it gets exemplified in the compensation benchmarks. And these, I think one of the points to make is that the choice of benchmarks for strategic asset allocation, compensation, and implementation, they're distinct decisions with different purposes for evaluation. So it's key to understand these differences and the differences in objectives so that we can understand why there could be different types of benchmarks for the strategic asset allocation versus how we implement. And I think one of the best examples is just to go through an example, whereas in private equity, we actually have two different benchmarks, one in the short term and one in the long term. So we start with the investment committee. Our long-term benchmark for private equity is currently the Russell 3000 plus 300 basis points. That's what we use in our strategic asset allocation to set how much of a allocation we'll have in private equity as an example. The board is also in the structure set a short-term benchmark, which is produced by State Street, and it represents the universe of private equity that State Street is able to collect through a cash flow basis. And the board is setting the private equity sub-asset structure, which includes both traditional and opportunistic segments. You know, the traditional structure includes venture capital, buyouts, debt and distress related, and the opportunistic is more of a tactical piece within private equity. When it comes to staff, for staff to implement, they can't implement by choosing the Russell 3000 and getting a 300 basis point spread. They have to implement on what's practical. It's a universe of private equity. So staff is being judged on the shorter term, less than 10-year benchmark, the State Street one that I had described. And we are deciding upon the commitments between the managers and weighting between the different subcomponents in the sub-asset class structure. And I think that's the same when it comes to the compensation benchmark. We can't really judge staff on that 10-year benchmark, but it also has to be something that's tangible. It's the universe of private equity that we can be invested in. So I just wanted to wrap up that there were a number of questions, and today I really wanted to provide a baseline, a foundation to move to a more advanced discussion as we move forward. And simply conclude that what gets measured gets managed. Good benchmark selection is going to lead to better decisions because it'll help provide better attribution to make those decisions. It's important for the board to understand the decisions that they're making, the strategic asset allocation, moving to the policy benchmarks, the sub-asset class structure, and the compensation policies, which then form the foundation for staff to implement. And next meeting, I'll field some questions to get some understanding for what the board wants to cover in the next meeting, but we'll think more about what CalSTR's process is, the evaluation of our benchmark selection and processes, and more in terms of the governance alignment and thinking about progressively as we have evolved and our investment organization has become more complex, the governance and frameworks has really been a long-term advantage for us. The board's governance, the decisions, and how can we maintain that? One of the governance frameworks which we haven't discussed that some of our peers use and we could consider moving into is a risk budget. Now that's something that June will be covering in the next segment, but it could really provide another alignment tool for the board and staff and consultants.
Comments, questions from the committee? A couple of folks. Sharon?
So Scott, back to that INV 118. And just the number of, benchmarks that is there a way to simplify that for us? I think I always feel a bit and I know we're large, complex, I get that, but I just wonder if there's ways that we can simplify or make it less complex. And is that just the nature of the beast that's?
And you're referring to the pyramid?
Yeah. Sorry. Yeah.
I think as we've evolved as an investment organization, one thing that jumps out at me is that the investors really want to find the best risk returns, and you don't have to worry about the investment folks getting more complex and sophisticated and wanting to optimize the portfolio.
I get that.
And that's a typical, that happens typically. But what we also have to consider that is as an organization, from the governance framework to things like technology and risk, how is the rest of the organization continuing to keep pace with that complexity and sophistication and the optimization of risk return by investment professionals? In the next segment, I'd like to talk about how we can continue to maintain a governance framework, and in my opinion, an advantage in that governance so that we can implement on a better way. And without getting into a lot of the details, I think this idea of a risk budget could really help to simplify this pyramid. And where that line is drawn, we might want to draw it up a little more.
Does drawing that line up, though, mean delegating more, or is that?
Measuring
guess I'm
it-
curious from our
I'll jump in, measuring it
consultants.
differently. So Scott and I were working on an analogy and came up with sports analogies, but I want to try and go away from those.
Shocking.
I know. But literally picture us as an orchestra, you know, winds, percussion, strings, trying to think of what else is an orchestra.
Brass?
Huh?
Brass?
Brass, there you go.
I don't know. I'm making
You've told us not only how you want the brass section to play, but then even down to each of the instruments, or in the wind instruments, not just, you know, how the flutes, but clarinets, and how each one should perform. And one of the options that we're seeing, Australia, New Zealand, and CPPIB, to name just some, which is the big Canadian plan, they're backing away with their board and saying, why don't you tell us at the orchestra level how you want us to play? We'll decide where we're going to put our energy, which one we want the best players in, and where to put some of those within a general framework, so you keep the asset allocation. But in settings getting so granular, you're much bigger, hence the word budget. You're much bigger at a budget of, we'll allow you to take this much deviation from the standard. And we'll measure you that. And part of it is the tools are getting much more sophisticated. When I think back to when I started here, we had one fixed income benchmark. It was Lehman Ag. Now it's called the Barclays Bloomberg Ag. But now we have non-U.S., we have high yield, we have all kinds of special credit. And so that's proliferated all these names instead of just saying, you know what, just even within the asset allocation or June's area, we have U.S., we have non-U.S., you have active, passive, you have emerging markets, just saying, you know what, instead of us making those sub-decisions of how much active, how much passive by region, we're just going to tell you, we want the global equity, and you could take so much risk. And then it's up to her team to decide where they take their risk, because it does change all the time. There are times when you want to be active and then not. And so what we're trying to explore with you is what we're seeing peers is move to a higher level or a broader level of thinking that maybe provide clearer governance.
Could I hear from?
And it's just another.
Hear from the
I'd like
consultants.
to hear from, Neil or Mika, if you guys have opinions on that.
Sure. I have one overarching comment and then an opinion. Aligned with a lot of the commentary earlier around how asset allocation is the largest decision you make. So because everyone's saying it, I wanted to make sure I had my chance. If you look at the pyramid, likewise, the top level of benchmarks, right, those asset class strategy benchmarks, those 8 drive the majority of what goes on. So I think to Chris's point and to Scott's point, as a board, that's where most of your time should be focused on, right? What do you want out of your global equity portfolio? What do you want out of those levels? As you move further down, and some of this is delegated to staff, but I think focusing on potentially a risk budget or other ways of raising that dotted line so that you really are focused on the things that matter the most to the portfolio. I think that from staff's perspective and from my perspective, it's important that managers all have their own benchmarks, right? So that you can really evaluate how your active strategies are performing. But do you need to be focused on all of the, those middle of the triangle areas? I'm not sure that from your perspective, it's helping you manage the overall program. And so that's kind of the way I think of this, is anywhere we can move that dotted line up a bit and focus you on those areas would be helpful.
So in the weeks and months ahead, we look forward to your suggestions on how we do that, if in fact that's the direction we're going to go. You still have.
Oh, I wondered if Neil had a thought real quick, and then I'm done.
Your question on do we need all these benchmarks? My response is yes, we do. And the reason we need them is we have all this proliferation of benchmarks. Maybe if Scott had done this report 20 years ago, maybe there would have been 16 benchmarks on there. But now there's, all of these. The reason this is happening is the investment world is becoming way more complex per Scott's other box chart. And we're trying to get somebody's got to get an understanding of the risks. And so that's what a lot of these are for. Now, my analogy is not the orchestra, but it's building a house. And that you need a certain, you get to decide as an owner of a home, if you're going to build a home, how much of the home you want to see. You're going to go to your general contractor and say, yeah, I just want this home out of the magazine. I've got a piece of property, and just go ahead and build it. I really don't care. So that would probably be the absolute tip of the pyramid. But if you want to participate in the process and dialogue with your general contractor, you're gonna wanna have a set of blueprints. And so that blueprints probably takes you down to somewhere around the 20 benchmark level. And that gets into both Mika and Scott's comments about where you set that line. But do you really wanna know the types of nails the subcontractors are pounding into the, whatever studs and how what floats they're using to do your driveway? The answer is probably no, you don't wanna get into that level of minutia, but those practitioners really need to know, they really need to have the expertise. And that's all those other benchmarks down below. So I think, in getting to Scott's comment on the active, the risk budget question, that's an interesting one because it's sort of an elegant way to sort of raise that red line up a notch and for you to have peace about it.
Because I think that's even more the question for me is not just, do we have to have this many benchmarks, but is it prudent for us as fiduciaries, as the board, to delegate more or to kind of, raise that line so that, you get what I'm
I'm with
saying?
Mika.
Is that prudent?
The answer is raise it up
Yes.
to a tolerable level
Okay.
and really focus hard on that. And
Got it.
the theme of the day is there's a whole heck of a lot going on in those 8 benchmarks, and it's all incremental after that.
Got it.
Yep.
Thanks.
So in the next presentation, I was going to say that the tool to really create in the governance framework would be to add a risk budget. And in that way, the investment policies may not have to specify every detail in terms of the flexibility of moving around, but you specify a very important thing, which is a targeted risk level. And that is probably more important to do over the long term as we set risk targets, what levels of risk are associated with that. So that will become one of the pieces to discuss in the more advanced benchmark education.
A few more members of the committee. Paul?
Thank you.
You're welcome.
So, this pyramid is fascinating. I think there's a question on the one hand, and I'll just say right up front, I like the idea of the risk budget and moving this red line up, because I think on the one hand, you have to say, is it prudent to delegate too much? You also have to say, is it prudent not to delegate enough? And maybe this board is really not as well prepared and qualified as our staff to set benchmarks and allocate risk within a risk budget. So I'm really glad we're talking about this. That being said, I have actually a different question that's not related to this. And that has to do with policy benchmarks, because I think Scott, you said that in our asset allocation that what we do is we adopt a policy benchmark for, say, private equity that's 300 over the Russell 3000. But I actually thought that when we do the actual asset allocation, we make estimates of each asset class returns. We don't benchmark one off the other. We have an analysis of what we think the private equity returns are going to be and the risk, and what we think the global equity, and so that's different, I think, than the policy benchmark. Is that right? We don't.
So I think that, are you referring to within the asset allocation framework, what we use to predict forward-looking returns are absolutely based, although you use a foundation of the public markets, we do have separate and distinct expectations for privates. Although I'll add the caveat that when we do any backward-looking scenario testing, we do use, and I assume PCA does and others, you end up using a public markets proxy because there's simply not a data set that it fits all the criteria listed earlier in this presentation that you can utilize to kind of run a benchmark going back for the last 30 years. So it's kind of a mix. So in terms of monitoring performance, is a little different than predicting forward-looking returns.
And I guess what I'm trying to figure, I don't know, Steve, you came up, you probably have something to say. I'll let you answer my question first, and then I'll follow up. Thank you.
We've already discussed with staff when we, we're gonna aim to align the private equity benchmark, the long-term private equity benchmark, with the specific assumptions that are used in the asset allocation study this year.
Okay, I think that will be helpful. I think it will clarify things, because I think the the problem that I've always had is when we say that that our policy benchmark is a 10-year benchmark, but we have to make decisions before we have a 10-year answer. How is that benchmark useful to us? In other words, we have to make every 4 years a recalibration of what our expectations are for private equity, presumably based on performance. But if we can only look back on what happened the last 4 years, were we right or wrong 4 years ago? I'm struggling with how we make a benchmark measurable over the time that we have to make decisions based on it, if that's possible. Maybe
Right,
it's not.
I'm afraid with private markets, the answer will be it's not
Okay.
it's not possible in a precise way. I mean, you really should be looking at a 10-year or longer period, given how those assets are priced and liquidated and invested in. So it is always going to be a challenge with the private markets to set benchmarks and determine whether the policy benchmarks you're setting are appropriate. But to Mika's point, we have more of a guide than just the last 4 years. I mean, private equity now has been an institutional asset class for at least the last 30 years. So there's more and more data with every asset allocation process that goes by.
Okay. Thanks.
Steve, you had mentioned that you were going to bring forth, if I heard you correctly, the private equity alignment, the benchmark. So I didn't catch the whole.
Yeah, so the issue that we've discussed is you and most other pension funds, incidentally, historically have modeled private equity to have a return somewhat above public market benchmarks. And then somewhat oddly, in retrospect, most public pension plans then turn around and place a benchmark on their private equity asset class that's higher than what they assume for the asset allocation. And I think Paul's point is at some level, those should be aligned. There's no logic in having them different.
Right, so a recommendation is going to come forward to us, and can you give me a timeline as to what you're thinking in on that?
We're working with staff,
Okay.
the private equity staff right now on addressing benchmarking within private equity. And I believe March is the...
March,
Would you
we're
keep
targeting March to bring.
Joy and myself in the loop on those conversations?
Sure thing.
That would be helpful. And looking forward to that, and trying to get some resolution and get that settled and resolved. It's important. Anyone else? A big issue, an important issue, what are benchmarks? Why do we have them? What are they accomplishing? Are they the right ones? If they're not the right ones, what are the right ones? And that's kind of how I look at it. And I know we've made some adjustments in the past on the real estate. We made some changes there. And I think that was perceived as positive and that there's a positive result. And I know some work is being done in the private equity asset class as well. I'd love to get that resolved as well. Scott, look forward to the next presentation and education on benchmarking. Thank you. Anybody else on the committee?
That's interesting.
And certainly offline would welcome feedback from committee members who've also asked that we continue this dialogue and conversation, making sure that their needs are being met by the presentations that are being brought forth.
I'd just like to commend Scott. That was actually a very good presentation on the issues of benchmarking right there.
I think the visual actually really helps me too. So.
Well,
Thanks.
if you liked it, I
get
said
it
blame
now.
the consultants. So.
That's good.
All right.
All right. Item 9.
Hi, June.
June, Kim.
Item 9.
Hello.
Again, it's an information item.
I need one seat, please.
And David Murphy. Wow. David Murphy.
David
Good to
Murphy.
see you.
Yeah.
I haven't seen you in so
Great to see you.
long.
He's got really good hair.
Yeah.
Good afternoon.
Hi, June.
I'm June Kim, the Director of Global Equity.
I'm Ray Venner, Portfolio Manager, Global Equity.
Great video.
Thank you.
Great video.
Thanks.
This is
David Murphy, Portfolio Manager, Global Equity. And thank you.
Yeah.
So if you watch the video, thank you. There will be a little bit of overlap. I ask that you bear with us. We're going to go into some more detail about the portfolio, though, so we'll tie it all in. And it is related to what Scott just spoke about, but we'll get into a little bit of detail about the global equity portfolio, and then we'll bring it back up. So please feel free to ask questions. This is an educational topic for global equity on active risk budget. Scott mentioned, I'll reiterate, there's two types of risk when we talk about risk. There's absolute risk. That's at the asset class level. It's incorporated in your asset allocation study. For example, global equity has risk in your last study of 19%. We're deemed riskier than real estate or fixed income. Private equity has higher risk than global equity. This is set in the investment policy and management plan. It's actually published in there what the absolute risk for every asset class is. There's also the concept of relative risk, or we'll call it active risk. And this is risk that arises when you differ from a benchmark. Our benchmarks are set by the global equity investment policy. And if we look at this slide, this is a picture of the global equity structure for CalSTRS. It's divided into two main sleeves, U.S. and non-U.S., active and passive. And our policy mandates active and passive targets of these numbers: 30% active, 70% passive in US, 50-50 in developed markets, 100% active in emerging markets. So that we're all on the same page. When we talk about active, we mean trying to beat the performance of a benchmark. And when we say passive, it means matching the performance of a benchmark or index. So benchmark and index are also synonymous. And if we change the amount of active that we have in any of these components, we are taking more active risk compared to the benchmark. If we lower the amount of our active exposure, we're taking less active risk versus our policy benchmarks. Historically, the global equity team has managed passive portfolios that are benchmarked just to a market cap weighted index, for example, the Russell 3000. And that's an index that's weighted based on size. So the largest company will get the largest weight, down to the smallest company will get the smallest weight. As the team has been built out over the past few years and we've increased our internal management capabilities, we have funded a couple of new passive index strategies that are indexed to benchmarks that are not market cap weighted. They're factor weighted, Scott mentioned this briefly, weighted based on other factors such as value, quality, momentum, including size. The industry refers to these as smart beta indices. But those indices themselves differ than the cap-weighted Russell 3000, so they have some active risk. This blurs the line between what's active, what's passive. And as the portfolio evolves, we think this is a timely discussion to have with the board, which is why we're here today with this topic. Ray will talk us through some examples, and then we'll come back.
In order to outperform, a portfolio must be different than its benchmark. But since the global equity policy benchmark is our center of gravity, we don't let the portfolio become dramatically different. To help us manage portfolios, we track numerical measures, such as active risk. For example, suppose in year one, the portfolio return is 3%, benchmark return is 2%, so the active return, the difference, is 1%. Active returns are uncertain and vary over time. Suppose in year two, the active return is minus 1%. Imagine that we continue to update this chart year after year with the active return each year represented by a bar 1 unit high. We'd find that over time, active returns would take on a bell-shaped curve. The values in a bell-shaped curve can be completely described by two numbers, the average and the standard deviation. And 2/3 of the values are within plus and minus 1 standard deviation of the average. Active risk is the standard deviation of active returns, the variation or dispersion of active returns around the average. In this example, active returns are centered around an average value of plus 1%, and 2/3 of the active returns are between 0 and 2%. As Scott mentioned, active risk is also known as tracking error. because it measures how closely portfolio returns are tracking benchmark returns over time. Next, David will provide some actual examples.
Thank you, Ray. I wanted to walk through a few examples of portfolios with different active risk profiles. So let's start with the moderate active risk portfolio, which would be considered a diversified active strategy. So this portfolio has an active risk of 2%, which is the standard deviation of the active returns, and an average return of 1%. As Ray mentioned earlier, 2/3 of these returns are within plus or minus 1 standard deviation of the average return. So when you look at the chart, you'll see that 2/3 of the returns are between -1 and +3%, which are depicted by the blue bars. The returns greater than 1 standard deviation are shown in green, and the returns less than -1 standard deviation are shown in red. So while the probability of extreme active returns are low, this portfolio could outperform by 8% or underperform by -6%. The last example is a high active risk portfolio, and it has an active risk of 6%. As you can see on the chart, the return distribution is much wider than the previous example. With this portfolio, you can achieve very high returns, up to 13%, or you could underperform relative to the index in a left tail event and underperform by -15%.
Can I jump in, David?
Sure.
Sorry, just a quick teaching moment, because for me, you'll hear, and when we talk about the asset allocation, you'll hear us use the phrase left tail. And I know that sounds kind of weird, but this is a perfect example of what we mean. It's literally the left hand of the chart, which is usually in negative numbers. And then look at the size of that. It's a long tail, and in our view, it's kind of fat at the end. It has a little bit blips back up. So that's called kurtosis, and we love the right-hand side, but we don't worry about that. Because positive returns are just good news. What we worry about is all those negative things that could happen on that far end. And you'll see even in the asset allocation, we'll spend a lot of time talking about that. 2008 is out at that end. 1929-30 is out at that end. And so those are the things, and I use examples, life. Life is not a smooth bell curve. You love the positive events, but what you really worry about, and if you think about it in life, we all gladly buy insurance on those things to hedge against those horrible outcomes. And you don't like paying premiums, but it's usually better than the alternative. So just always keep that in mind, the phrase kurtosis or left-hand tail or fat tail. Think of this graph, and those are the kind of things that we're talking about. Negative, what does that say, 12?
-15.
-15.
Yeah.
That's bad.
Yeah.
Really bad.
All right, moving on to the next slide. So the global equity portfolio contains strategies that encompass the entire active risk continuum, ranging from full replication all the way to high active risk strategies. For full replication or passive portfolios, the active risk is really low, as the goal is to match the benchmark return. But you can see on the chart that as a strategy's active risk increases from low, moderate to high, the potential for active returns also increases. So let's take a look at how global equity is structured with these types of allocations. We'll start with the U.S. equity portfolio. So it shouldn't be a surprise that most of our assets are allocated to passive strategies. We have $45 billion allocated to passive, which really seek, as I was saying before, to match the returns of market cap weighted indices. Currently, we don't have any strategies in the low active risk. Within our $5.9 billion moderate active risk allocation, we have external active managers, but we also have our internally managed smart beta strategies, such as fundamental index and diversified multi-factor. And we have $2 billion in high active risk strategies. Compared to the U.S. portfolio, our non-U.S. developed markets allocation, it has a lot more of a balance between the passive and active strategies. We have $19.3 billion in passive, and again, similar to the U.S., we don't have any in the low active risk strategies. Our $12.3 billion allocation to moderate active risk managers contains a mix of quantitative and fundamental managers. And we have a relatively small amount of $2.6 billion in the higher active risk strategies. So when looking at the emerging markets allocations, one of the things that you may notice, we don't have any in passive, and that is consistent with our global equity policy of being 100% active. We do have one low active risk manager with the $800 million allocation. But if you really look at this, we have an even distribution between the moderate active risk portfolios and high active risk portfolios. And the reason why we do this is to take advantage of market inefficiencies that give us the opportunity to generate excess return.
We're going to go through another analogy. I know you've had a lot today, but we think this is a pretty good one. So to talk about an active risk budget, we're going to, if an investor wanted to create a portfolio with these different strategies that we just talked about, passive, moderate active, high active, how would you do it? And one way to do it is to create an active risk budget. And what is that? So an example you can use is an example of a diet. You can set yourself a 2,000 calorie a day diet. And you'll decide it's going to have just 3 components, vegetables, but very low calories, so you could have a lot allocated to vegetables. You also want some proteins, higher calories, but you do want some in your diet, and then some fats or cheeses, which you want in your diet, but at a lower proportion. So you can determine these are the 3 things you're allowed to include. The mix could change, and you need to stay within your 2,000 calorie a day diet. Similarly, when you create an institutional portfolio of a lot of different strategies, you can set what's called an active risk budget. It's one number that you set in advance. For example, let's set an active risk budget of 50 basis points. That's 0.5%. And we'll say you can hold passive strategies. They could get a higher allocation because they have low to no active risk. You'll also have some low active risk strategies, but at a smaller allocation. And we will have some high active strategies because we do want to beat the benchmark. Again, what you've said is one number, one active risk budget number. You can change the proportion between these, and we're only allowed to invest in these types, but we have to stay within that budget that you've set.